In this lecture, we're going to learn about some great tax shelters that will let you keep more of your earnings on stocks. First, we'll look at individual retirement accounts, or IRAs for short. Then we'll turn our attention to 401k plans. Traditional IRAs have been around since the Employee Retirement Income Security Act, better known as ERISA, in 1974. You'll see that these accounts are among the most powerful investing tools at your disposal. Tax shelters aren't just for the big boys. According to the Investment Company Institute, an IRA is a trust or custodial account set up in the United States for the exclusive benefit of an individual or an individual's beneficiaries. That definition is fine for technically minded folks, but I like to think of an IRA as just a special label that we stick on investments. What's special is that the investments with this label, including stocks, get a tax break. The same goes for a specific type of an IRA, a Roth IRA, or a 401k account for that matter. You can put your IRA label on most of the stuff you typically hold, including stocks, bonds, mutual funds, and exchange-traded funds, more commonly known as ETFs. If you do put those assets in your IRA, then they'll earn the same return they'd earn outside of the IRA, except for one big difference. The assets in the IRA or 401k have major tax advantages. Investors around the world have a saying, it's not what you earn that matters, it's what you keep. IRAs let you keep lots more of your investment returns. You just need to take a little time to learn a few details, and then it's simply a matter of taking action. We'll learn about two types of IRAs. First, there's the traditional IRA. More recently, Senator William Roth of Delaware sponsored legislation establishing what are commonly called Roth IRAs in 1997. The main difference is when you get your tax break. With a traditional IRA, you get your tax break up front. If you invest $5,000 in a traditional IRA and comply with some IRS rules, you get to deduct $5,000 from your taxable income. Instead of reporting taxable income of, say, $50,000, you only report $45,000. If your marginal tax rate, that's the rate you'd pay on that $5,000, is 25%, which is what a single taxpayer would have paid on that amount of income in 2013, then you're going to save yourself $1,250 on your tax bill that year. The tax break on a Roth IRA is different. It doesn't come up front in the form of a tax deduction. Instead, the funds you place in a Roth get taxed, but then, subject to some IRS rules, your earnings on that investment will be tax-free. Yes, I said tax-free. If you invest $5,000 in a Roth and 10 years later your investment is worth $15,000, then you've just earned $10,000 tax-free. As much as I love IRAs, there's no free lunch. Congress authorized IRAs to ease the tax burden on your retirement savings. You're not supposed to use your IRA to save for a vacation, for example. Congress imposed penalties for withdrawing funds from your IRA before you're old enough to satisfy the law. Also, you can only contribute so much to either a traditional or Roth IRA each year. We'll get to those details later. IRAs are a terrific way to improve your investment returns. Suppose you and your best friend forever, Megan, each decide to allocate $750 a year to your investments. Let's say that both of your tax rates are 25% and that you earn 6% before taxes. The only difference is that you put your $750 into a Roth IRA and Megan puts hers into a taxable account, like a bank account or a CD. Every year for 30 years, you both do exactly